Good afternoon, everyone. The post-lunch session is always more challenging than the other sessions. We hope we make it interesting enough to keep you all awake and active and to participate in this. India is a very credit-hungry nation. We have a lot of shortage of funds in various sectors of the economy. But the credit deficit in some sectors of the underserved sectors of the economy is both a challenge and an opportunity. We have large institutions, large banks who have substantial pools of capital which they sometimes struggle to deploy. But they also have the challenge of very stringent policies, processes, and poor outreach to the underserved sectors of the economy. We also have NBFCs and of late the new breed of fintechs who have the agility to be able to reach out to the corners of the economy, who have the nimble-footedness, who have the technology to be able to do an efficient and cost-effective outreach, but who lack access to adequate pools of capital. And it is the matching of these two segments of the economy which is supposed to be met through the new initiative of co-lending. Few years back in 2018, the Reserve Bank of India came up with a co-origination strategy, which was preceded by a business correspondent strategy. So we have been gradually evolving from business correspondent to a co-origination to a co-lending model, which was announced in November 2021. Post that, there has been some movement in this regard, but have the untapped pools of capital been tapped? Have the underserved segments which have a huge appetite for credit been accessed? Has this particular initiative worked well? And what are the challenges and opportunities in making this collaboration happen? These are some of the questions which would be touched upon, which would be debated during the course of this session. I have a very eminent panel of members here, experts in the financial sector field. We have two heavyweights of co-lending sitting to my right, Chetna, Aggarwal and Atul, Prakash. I have, from Avanti Finance, we have Manish also, who has also moved into co-lending apart from conventional financing. We have Manu Prakash from CredAble, who is focused on the SME, particularly the supply chain financing area, which I suppose is an area which has not been tapped so adequately in co-lending, but which, if opened up, could become a huge area of opportunity and business. I have Paritosh on my left, who is taking care of processes, whether in terms of onboarding of clients, KYCs, etc. So who is a process expert. So we have a very highly balanced team here of practitioners, and I'm sure they will come up with a lot of insights into this new area of activity and come up with a lot of suggestions and solutions for the problems that are being faced. So we'll start initially with a few general conceptual points, and then we will move on to more operational details. To start with, let us talk about whether the synergies between the capital-rich bankers and the fund deficit NBFCs, has that collaboration synergy been achieved? What are the parameters which are required for achieving that level of co-lending, that level of synergy, which would make co-lending a successful initiative and a successful business sector for the future? These would be the questions that I would like to share, ask a few of my panelists. Maybe I will start with Atul Prakash. If is as a person who has been in the financial sector and now who's also practiced co-lending, could you tell us the potential of this synergy and the challenges that are being faced in this synergy?
Thank you. I think the genesis of this entire co-lending mechanism was from the fact of, I think, what you rightly said, that there are banks and entities who have a lot more cash to deploy, whereas that there are shadow lenders who have the ability to deploy the cash, but they lack the capital, requisite capital, so to speak. In terms of, if you see the way the industry has evolved for the past 3 years, I think to be precisely, 2018 it started, I think it's evolved only the past 3 years. As the shadow lenders have started aggressively going in the market and their customer segments, and that's where the consumption of capital has from the whole co-lending ecosystem has basically taken place. I think the future for co-lending per se is extremely bright. That's why you'll find both technology folks focusing on this segment, because and I can talk about my segment where our industry, where our companies, which is the affordable housing space. This is a very exciting space to be in, where banks have realized that people like us basically have the requisite wherewith to distribute and collect these loans in that market, and if they have to be backed by the requisite capital, there is the whole growth story of Bharat comes into picture. So I think we are at the crux, at the right inflection point, if we can call, in the co-lending.
Thank you, Atul. Yeah, that's interesting. I will now ask Chetna. There were two very primary objectives apart from the access to funding. Those objectives were that the remoter or less served segments of the economy would be reached through this complementarity of this partnership. And second, that the cost of funds or cost of loans for these segments would come down from the traditional, say, microfinance segment lending of 20s plus, 24 to 26%. So, which was engendered because of high transactional costs. So, whether these two objectives have been at least partially or maybe fully achieved through the practice of co-lending.
Hi, thank you for the question. And as you rightly said, these two objectives, I'll first start with a very few numbers which I have done by heart to come. India has almost 311 million households, and of which 45% is lower middle income group. Then we have approximately, tier 2 plus cities contribute to 85% of the population. And most of it is really unbanked in nature. And then we have MSMEs, which contribute to, there are 60 million MSMEs, which contribute to almost 30% of India GDP, and also has a credit demand gap of approximately USD 530 billion. So this is the opportunity we are talking about when we talk about the synergies between the traditional financial institutions and the fintech sector. And therefore, I completely agree with you. Maybe not fully, but yes, some access and some accessibility to these sectors has increased with the help of co-lending. And the same is expected to definitely go much beyond, deeper into this segment. Most of the fintechs are, trying to come up with innovative models in terms of customer experience, in terms of instant loan approvals, in terms of new strategies for credit underwriting and scoring. So the reach is definitely increasing on a day-to-day basis, I would say. And the purpose of co-lending, where RBI was looking at to increase the financial inclusion, that's definitely coming out. Even if we see RBI Financial Inclusion Index, it has grown 5% year on year in the last 5 years. So, that's definitely one purpose which is being solved. And now when it comes to the question of lower costs, so fintechs have definitely more digital sort of model. They have less engagement and investment in brick and mortar thing, and therefore and they have now access to banks wide pool of capital. So these two things brought together are removing the unorganized lending market to some extent, and therefore the people who used to borrow money from money lenders at very exorbitant costs are definitely looking at some unsecured personal loans in the range of 35 to 40% IRR, which is, I'm sure, definitely not to that extent, but yes, reducing the cost for them. And even in the personalized reach to them and the customized products which fintechs are able to provide, that's definitely helping them out.
Thank you, Chetna. I think that was helpful. I will ask Manish. See, this co-lending, which is bringing in a unified rate, which is obviously a lower rate, despite the fact that each of the partners are getting what rates they are used to or they are desirous of getting in terms of their business model. So, is this going to be a challenge for standalone lenders, say the microfinance lenders, who have been performing a very useful role in creating access to the underserved segments? But would this become a kind of a divide between the haves and the have nots, those who have the co lending arrangement and the have nots who were serving the segment well, but who do not have the co lending arrangement, and so they have to continue to lend at a much higher rate and they could become uncompetitive?
Well, I think that's probably something which we might look at that problem when really this scales up. Initially, I think all these opportunities will go to people who are more tech enabled, people who are more progressive. Banks, because of internal requirements into the priority sector lending, will grow into this business. Even the smaller microfinance companies, etc., who may not be tech enabled, but with people like players like Signzy, etc., playing role, making the tech available at a more competitive rates as we scale, is going to be the answer to that. There has to be, and that's where the entire collaboration part of it, even the smallest of microfinance companies are important partners, because they provide an access which for a bank the cost of that access is very high, and they fulfill a particular gap. So in my view, no, it will not make them uncompetitive. It will make them more attractive for various other partnership models to really play out, and because they fulfill a very strong on ground gap which many large players cannot fill. So especially microfinance, for some time there will be a phygital model. So the physical presence on the ground is going to be important, and therefore they will also have a space in this model to grow, and with the help of technology players they will become more competitive. That's the way I look at it.
Thanks. I think this is something that is going to play out over the near future, and we would need to watch this closely, and to ensure that either the co-lending really spreads fast enough to cover all the good grassroots players so that they are not disadvantaged, or some other solution is found for them. Next, Manu Prakash, we have not, to my knowledge, we have not seen any co-lending in supply chain financing so far. If that was to start, what would be the areas which have to be taken care of to ensure that that gets a fair start and a good growth ahead.
Thank you, Ramesh. So I think supply chain as an asset class, both the participant as well as the investors are not many currently in India. But supply chain as an asset class in terms of syndication, participation has been there for decades across the globe. Now coming to an open account trade in India, wherein we are looking for investors to understand the market, along with the technology that they can bring in terms of quick liquidation as well as replenishment of the assets. That is something need to scale up, and that's where I think a fintech like us and few others bring the technology to the investors. Also in the supply chain, which is currently in India, the loan book is built on the borrower, which is a MSME, which brings in the priority sector aspects to the larger banks as well. Whether to frame it as a participation, whether to frame it as a PTC, securitization, or any other mode is something that the industry has to join hand and grow this asset class. Also on the supply chain asset class, the classification RWAs is something that needs to be clearly defined under the Basel norms, which has to be followed by various lenders. And that's where once the knowledge percolation happens, the asset class in terms of co-lending / BC model or something else will be scaling up.
Yeah, that's very interesting. Actually, the supply chain financing itself in India is still an area with a lot of aberrations and a lot of gaps.
Especially the open account supply chain
Yeah.
is just scaling up.
Yeah.
And whether to treat a borrower or the asset as an operational creditor or a financial creditor, those understanding, I think regulator needs to step in and take out circulars out.
Yeah. The other as a part of it is that while the banks have taken care of the large chains, whether it is the Tatas and the Marutis and the Hindustan Unilevers, etc., there are a lot of SMEs in the supply chain who have not been adequately served even by conventional banking. Now, can we look at this as an area of opportunity for co-lending in the SME segment to bring in to the co-lending fold and hence to the financing fold the smaller SMEs who are both on the supply side and on the distribution side for the supply chains?
Yes, so I think MSME on the supplier side, for example, MSME being a supplier to a large OEM player, that sort of asset is largely most sought by the banks, and that's where the origination of Trades platform of RBI also came into inception. And once outside the trades, maybe somebody who is not MSME but a very prominent supplier to a large OEM, those asset class I think should be quick absorbed by the new investor. So what another thing that we have done is that the last transaction that we did, that was under the circular of securitization, and now an individual like you and me can also invest in a supply chain asset. So bringing as a CLM1 or a CLM2 model into a supply chain, other avenues are also opening up. Just that to stitch whether it's a DA or a CLM1, that requires a lot of technology enhancement at the banks end as well. And once it happens, maybe 6 months, 2 quarters, 3 quarters, we can see a lot of flow of money into this segment, and the industry will benefit overall.
Are there any softwares relating to supply chain financing which would cover the co-lending aspect?
Yeah, so I think I would be marketing my company in that way. So I think this supply chain tech is something that we are building for 3 large banks in India and few banks in Southeast Asia. But yes, without technology, supply chain financing, especially on the open account, cannot work. So either the banks who are working with archaic models or supply chain from the tech perspective, they are scaling up. New RFPs from most of the PSU banks are now coming up. And within that supply chain module, they are asking for co-lending module as well. So once this implementation happens, we will see a lot of upside on the co-lending on the supply chains, largely on the payable side.
Thank you, Manu. Yeah, Paritosh, see, the banks and NBFCs or banks and HFCs are joining together as partners for co-lending. That is happening. But I think now with the new developments happening in the Indian economy, with the fintechs playing a very important innovative part in cutting down costs, improving efficiencies, reaching out to the unbanked. Would it need a kind of a tripartite arrangement of process givers who the process experts taking one part of the co-lending tie-up, the NBFCs in the middle and the banks at the other end, to have a tripartite kind of co-lending model which would really work and take care of a lot of these gaps?
Thanks a lot for asking this question. I might not able to answer it very correctly because when you have fintech, NBFCs and banks, somehow they're already working with each other in the larger ecosystem. So if you see a lot of fintechs nowadays, and thanks to RBI lately, which they have came up with a 5% FLDG and other co-lending norms, as mentioned by Manish itself, correct? Bank cannot distribute product at scale to every part of India and Bharat. That has been evident now, and they've accepted it. That's why there's a need of NBFCs now. MFI is a sector. What fintech, NBFC and bank as a tri-party can come up with is they can distribute the risk in a very different format. There's a lot of players. Let's talk about MFI for example. There's a lot of small MFI which are disrupting at ground level, and they are still trying to figure out how they can scale faster. They are currently trying to get co-lending with NBFCs, banks, and so on and so forth. But they need a technology partner to help them scale. So now I think in this era of technology, scale is dependent upon digitization, and it has been democratized now. So now, earlier it was bank who had money, but obviously bank had money, but they can't invest that money at that scale. Now even a fintech startup who has a distribution, so for example, a company like Cred, just a very simple example, correct? A lot of folks do believe that they are burning like anything, but the amount of book that they've created from one of the bank, though we can always talk about the risk they have, but in their approach, they are able to raise. They're one of the largest companies in the space, at least in the fintech side, to gain such sort of a book in such small time. And I'm not just taking the names, correct? Paytm, every other company is correct. So I firmly believe if you have distribution as a moot and you have a technology in hand, every other manufacturer, either it's NBFC's bank, they need to come together to ensure every party is winning that game and helping customer to win in long term. And it's gonna obviously reduce the interest, be it gonna have a seamless experience of onboarding, underwriting, collection, and servicing of the customer, which has been a pain point for a lot of Indian customers while they are taking product from banks. So I believe from a process point of view, RBI has done a pretty remarkable job. On co-lending side, obviously they are doing their bit. While we were talking pre-session, I think co-lending is not as complex as we have thought through. It is still, as I think I was talking to Manu earlier, so he was saying it's very simple, though we have complicated it in our brains using our cognitive bias. But my point is very simple. Manufacturer needs to come with distributor, and wherein technology need to marry with all three of them as a process and as a collaboration in times to come.
Thank you, Paritosh. Yeah, I think that is very important, really, to understand the ecosystem as it is developing now. Now, we have this co-lending model which has been rolled out. We have two parts of it. One where the portfolio is straight away taken over by the participating bank from the originating lender, and the other one where they pick and choose, cherry pick. Now, the methodologies for the two are different. For one, the first one, the RBI says the bank is still responsible. It cannot outsource the credit underwriting process, rather the credit decisioning process. So it will have to still do its own due diligence and assessment. For the second model, it says, okay, you can cherry pick and choose, but then it will fall under the assignment model, direct assignment model. Now, I want to ask Atul, are these two divisions like this creating some operational complications in terms of collaboration? And if so, what are those problems and challenges?
Short answer is yes. But I'll just take a few seconds to just elaborate. I think both models have their own merit. I think RBI came up with first model number 1 and it realized that which is nothing but a parallel underwriting. It realized that there is still a room for a kind of lender who would want to come after I have given loan and so-called cherry pick that transaction. So I think since it's an evolving field, I think we have to give credit to RBI to also trying to figure out which model works the best.
So it's still in some sort of an evolutionary process.
I think definitely we have still not reached those US kind of warehousing model of where I just generate the loan and within 7 days I pass it on to a particular servicer. We are still not there. I think with this model, maybe RBI is trying to basically categorize the generators, people who generate loans, versus people who distribute loans, versus who have the warehousing capacity to keep the loans. And then there are people who have the capacity to service and milk these customers for further cross-sell opportunities. So I think it's an evolving part. And I think Chetna can also add there because she's also playing a big role there.
So when it comes to CLM1, the first model is when we are underwriting together, it's CLM1, and for the sake of better conversation, I will use CLM1 and CLM2, which CLM2 is akin to the assignment. So I would see ultimately the goal of RBI is to support the liquidity and the balance sheet, provide the balance sheet support, and that is what is being successfully done. Now, in terms of giving a choice to the players in the industry, RBI has given both the choices. With the whosoever NBFCs and fintech entities are tech savvy,
which one are you comfortable with? More comfortable with?
So I am currently participating and more active on CLM1. So I would say I would be comfortable doing CLM2 as well, but I'm being an NBFC. I'm not sure if NBFC within NBFC can do CLM2. That's still a gray area, and we are trying to figure out. CLM2 is more of a bank to NBFC sort of relationship, where bank is getting participation into PSL sort of segment with the help of these NBFCs, and NBFCs are also getting liquidity or balance sheet support from the banks. So I think RBI has just given a choice to operate and to work according to your strengths and weakness. And most of the entities who are playing a big role are the fintechs, and they are very, very tech savvy. And therefore, CLM1 is becoming a easy mode of operation with a lot of API integrations available, with lot of KYC digital checks done, underwriting scorecard method, and the lender basically is trying to they are trying to do a cherry pick here also, sort of. We put gating filters according to what we are comfortable with for our balance sheet, and that's what we are doing here also. So I think it's most just a choice of operation in terms of what route you want to take in CLM1 or CLM2.
Now, I mean, this would be a question to all the members of the panel. What is the risk assessment framework that you think will work best? Whether whatever we are having right now is okay, or what improvements are required in this? Maybe you can start with Atul, and we'll run through the panel.
Can you please repeat
No, the risk assessment framework. I mean, whatever has been, regulations have given you certain things, and you have your own risk management systems. For running a successful and large-scale co-lending model, is this risk assessment framework, which is right now available, adequate, or are there some improvements needed?
I think the moment in terms of the existing framework right now, since in any case I am deciding to lend on a particular transaction, I think my risk frameworks are supposed to be already in alignment with what is expected. So I don't see much.
Actually, you don't find that there is a need to tweak it in a significant way?
Considering since I am a regulated entity, I think that is one advantage which I have. Whereas if and I think going forward, non-regulated entity in any case in these fields will not be able to manage
They
it.
will not be able to
Yeah.
do really. It
So
is-
I think, according to me, see, and regulations, I don't think anybody can say that they are enough. As
Right.
and when
No, as of
evolution
now, no,
happens,
the comfort level is what
comfort
I'm
level
asking.
is there as of now with the current situation.
Are you comfortable with the existing framework?
I have
Yeah.
something to add
Yeah.
here. So, when we talk about risk assessment framework, especially between the two entities which are operating together, so we talk about a lot of risk assessment is only based highly on data. So we talk about data integration, we talk about data sharing, and we talk about lots and lots of data analytics. In fact, we have set up a new team completely to do the data analysis for being able to do the risk monitoring on a regular basis. But I would like to take one step back. Even though we have lots of data, there's no standardization of the risk metrics, basically. So this industry largely knows the concepts like PAR 60, PAR 30, PAR 90. But then how do you calculate PAR 90? That's like, varies with one entity to another. How do you calculate your ECL? That also varies from one entity to another. So there is a humongous challenge in how one entity looks at their credit loss, expected credit loss, vis-a-vis how would the lender look at the expected credit loss.
So you
So
would say that
there's a lot of misalignment, and industry needs a lot of standardization around it, the concepts, and how this data should be thrown by the system without any manual intervention.
So-
The automation of
So
those
what I learned from
calculations,
what
yeah.
you are saying, yeah, is also
Yeah.
that maybe some amount of standardization is required in this area also.
It's, I think,
in
a
terms
lot.
of
It's
that.
a lot of
Okay,
standardization.
okay. Manish, see, has this framework reduced the systemic risk for NBFCs and MFIs, the co-lending framework,
Yeah. So I'll continue
because
with-
of governance, because of kind of overviewing by the the larger partner with these issues.
So that was my answer to even the question that you asked earlier, that an additional layer of risk that the co-lender or the bank will need to look at is the originator risk and the originator entity risk. Because as was mentioned, there is alignment in terms of the policies for lending to the borrower. So there is a full alignment which needs to be there for the entire co-lending to work as efficiently, especially if it comes to the unsecured PLs, as well as something which is purely done in an integrated automated mode. So the rules of the game are clear on both sides. But an additional layer of risk management that the bank will have to really look at is in terms of the risk as a
Definitely a
originator, as an
positive
entity.
from that point of view.
Their practices, their processes, their balance sheet, their viability, their sustainability is something that the banks or the major partner will have to really look at. And originators' ability to meet the regulations. One good part about it is RBI has created an ecosystem of regulations with the co-lending regulations and the digital lending regulations. It has provided a very good governance framework as to what is required
Good.
for the originator
So
to
I
service.
think we are all agreed on that. That the
Yeah.
framework is good. Any thought on the risk framework, Manu?
Yeah, I think the trust plays a very essential role here. And I think once the policy has been framed, the next buck is passed to the lawyers who are drafting the agreements between the originator and the investor. The robust the agreement, the lucidity in the agreement mitigates the risk to a larger extent. See, most of the things comes into picture when something really goes bad with the portfolio. Till the time everything is going good, hunky-dory, nobody questions the underlying agreements or the policies. But when something goes wrong, then only people
We'll
start
really-
questioning
we'll
whether
really
the
know.
policies were there or policies were not there. See, largely when the two banks were doing co-lending among themselves, and both the banks were Basel compliant, whether it is the definition of PAR, ECL, or any other parameters, they were standardized. But as soon as the new players like NBFCs, SFBs come into
No, no.
picture,
See,
Huh.
here, only when animals of different breed cohabit, you have a lot of new challenges coming in. When they are of the same breed, same pack, you don't have a problem really. That is what
whether
has
the
happened here.
Zebra has white lines painted or black lines painted, so that's a different question. But yeah, so I think the more trust between the participants, be it the original lender or the borrower, is there. I think it's a good story to build on.
A very quick answer from Paritosh. In the process part of it, in terms of onboarding, in terms of KYC, can you quickly tell one or two improvements which, or acceptances of some practices which would make a difference to smoother co-lending business?
I think I'll quickly try to answer this. I think there's a lot of things that has happened from RBI. I'll just again quote Manish. I think there's a great framework that is already put in place by RBI from digital lending perspective, from a guideline and framework. And same goes for the co-lending side. I think as a country, let's understand where we are right now. If we compare ourselves in 2008, almost 15 years back, I would love to quote Nandan here, that India has become data poor country to data rich country. Now you have a stack like Aadhaar. Your stack, every OVDs can get validated. You have a stack like account aggregator, which can marry with data points like alternative data. There's a lot of, and I think Chetna talked about the analytics, correct? There's a lot of data. I think there's few things that I think that needs to be improved. How we can democratize the access. So I firmly believe video KYC as one of the product has really shaped it well. I think the true potential of video KYC in times to come, we all gonna see together.
Banks also need to accept that.
Correct.
Possibly.
And bank, I think RBI has given the full mandate now for every side, individual SME, that you can get your services.
Time's up.
So I think that's my point. I think video KYC should be the future by which we can democratize.
Important point.
Yes.
Thank you. Yeah, I think more or less we have a very good consensus among the panel about the framework being positive, good, still evolving, some fine tuning to be done, but in terms of reducing systemic risks, improving regulation, governance, improving co-working together of larger institutions like banks and smaller ones like NBFCs and fintechs, I think we are on the right path to progress. Maybe we'll just take one more minute, take a few questions from the audience, if there are any questions.
I think the lunch was really
Yeah,
good,
I think the lunch has taken care of it. Oh, there is one hand there. Yeah.
I have two questions.
Oh,
One
okay.
is when co-lending happens, who is a major partner? I think their policies prevail. And as it was been discussed, whether it is zebra or other animal, the one who is of a lesser percentage will have to agree to a bigger partner. I think this is where somewhere the innovation is also getting killed in co-lending. So what is the opinion of panel on this part of it?
I will take this question.
Yeah, please.
Since we are the bigger fish in some place and we are a smaller fish in some places. I think the premise of co-lending was that a bank is unable to understand a customer segment which a shadow lender understands better than it. So logically, it is our policy which gets approved by so the policy has to get approved by the larger lender who's the 80% share. So they approved our policy, and then that becomes a joint policy on which the underwriting happens. Wherever is the other way around, that the model will fail, because ultimately that larger lender is unable to reach that customer segment. That's why they wanted to do a co-lending in first place.
Yeah, so whether it's a seller's market or buyer's market, that will determine whose policy would be adopted. But largely all of us seen, the guy who is originating, his policy is kind of prevalent.
Right, I suppose that will always prevail. Yeah. What is the second question?
The second question is, we have not seen co-lending in green financing.
Okay. Yeah, I'll take that. Recently, there was an interesting statement by the chairman of State Bank of India, Dinesh Kara, who incidentally used to report to me in the bank. he said that banks have a lot more to do in terms of going in for green lending, and that it is whether it is in terms of solar or renewable energy or other energy reduction areas, that banks are not concentrating on that. They have not done enough, and they need to do a lot more. I think that is something which probably opens up more opportunities for co-lending also in the future. If the NBFCs and the fintechs are more oriented to the planet friendly policies and processes, I think that would help the banks also to move more to a green lending portfolio in their books. And to that extent, I think it would open greater opportunities for co-lending also.